In this video, we're going to continue our discussion of risk and return. So we've established how to calculate the return, some standard deviation of historical data. So now we want to take another step further. And the first concept we want to think about is something called excess returns. This is the difference between the rate of return on an investment and the average rate of return for treasury bills. So in this case, if you remember, we had T-bills. We're averaging around 3.13%. And we had the rate of returns for the other particular assets. So if you take small stocks, take that rate of return, which was roughly around 18.6% or so, subtract 3.1, that tells us that the excess rate of return for small stocks is 15.3%. So let's think about this. You could invest in risk-free assets, treasury bills, or you can invest in small stocks as a sector, if you will. So the difference on average for any small stock above risk-free rate should be around 15.3%. S&P 500 is about 8.6%. But the point we're trying to make here is that we're looking at sectors. Where we're ultimately moving towards is to think about how can we determine an expected rate of return for an individual investment. It's going to take some more videos to work our way through this. But the first thing we'll think about is this relationship that we've been building, right? That there is a relationship between volatility and average returns. Large stocks tend to have lower volatility than small stocks. All stocks tend to have higher risk and lower returns than large portfolios, right? So individual things attempt or appear to have higher returns than large portfolios. Now I have a graph here that I think is kind of interesting to look at, and this is the S&P 500, and let me expand it just a wee little bit more so it's easier to see. So the biggest 50 stocks in the S&P 500 are denoted by the triangles here, these gold triangles. And if you notice, these 50 largest companies are down in this area here. Remember we had this graph earlier that said how the sectors went out. Now we're looking at individual stocks. So individual stocks, risk and return, the largest 50 are in this area. What about the next 350 stocks, right? If you look, now there's a few that are outliers, right? But most of them are slightly to the right of the 50. And of course, the last 100 are to the far right here. Again, some are a little bit in, some a little bit out. But the general idea here is what we're showing is that individual stocks, just like the sectors, are also spread out so that there is a relationship between risk and return. So there's no real universally agreed definition for risk. There's lots of ways that we can measure risk. We're going to concentrate on the most typical definitions, which are referred to as variance and standard deviation. So standard deviation is the statistical measure of the spread of a sample, sometimes referred to as dispersion, right? And this is the measure we're going to use most of the time. The basis of this is a normal distribution. Many of us are familiar statistically with what a bell curve looks like. This is a normal distribution. we're also going to be able to use this statistics for a variety of other measures to help us understand the relationship between risk and return. So again, coming back, here is our normal distribution. As you can see, it is divided into pieces. These are standard deviations, and they are equal segments moving away from the mean. So the probability that a yearly return here is going to fall between 19.8% of the mean is about 2/3. So how does that work? Well, here's 68%. The volume underneath this curve, the volume here represents the probability, right? A probability that the return is between these 2 points. So there is a 68% chance, 68.26% chance that the rate of return on this investment will be somewhere between -7.7 and 31.9. That's a pretty big range of numbers. So again, the idea here, the normal curve measures dispersion. The greater the dispersion, the greater the risk. So continuing on with some discussion on returns. There are two ways we can, there are more ways, but there are two primary ways we can measure returns. The arithmetic average is what we've been discussing. This is the straightforward, it's just the average, right? Now there's also something called the geometric average. Now the geometric average takes the returns per year and looks at how that grows over time. It applies a time value of money to the concept of returns. Now, this geometric average is always going to be less than the arithmetic average unless everything's equal. It's always going to be a little bit less. Now, so which one is the best to use? Well, the arithmetic average is overly optimistic for long horizons, and the geometric average is overly pessimistic for short horizons. So the longer the horizon that you're talking about, the more likely you would want to utilize something called the geometric average. So let's see how we calculate that. Here we have 4 years of returns, and we would like to calculate the geometric average. And these are just holding period returns. First year we earned 10, then we lost 5, earned 10, 20, earned 15. Now there is a worksheet. This worksheet is called the geometric average worksheet, or the geometric return worksheet. You add the returns. Now, we have to have equal probabilities. If you're just looking at time, of course, they would be equal. If you were doing some prediction, you may have different probabilities. But what we're talking about here is time. These are the actual returns. Divide that by the number of times, so it'd be 0.25, right? So if you look down below statistics, the arithmetic average is 10, and the geometric average is this 9.584. So again, this is just a calculation. The geometric average is a compound return, where the arithmetic average is just strictly, you take the numbers, you divide by 4. So from 1926 to 2017, the equity risk premium has been fairly large. They talk about earlier years, right? 1802, most of us weren't around there. They had fairly smaller estimates, around 5.4%. But in general, what we've been able to see most recently is the international equity risk premium is around 6.9. In the United States, it's about 7.2. So again, we have this risk premium that if you want to invest in equity in general, instead of risk-free, you can expect to earn somewhere between around 7%, maybe as much as 8% higher by investing in the risky things that we've been talking about compared to the risk-free asset. So I look forward to talk to you in the next video.